Another one that I think it kind of ebbs and flows as we get over kind of our next case here, at least if my math is right here, is it deals with section 108 and cancellation of debt of debt and adjusting basis. So yeah, what do we have here?
First of all, between me and you, I chose this case because it's called Hussey, and it just makes me think of what my 80-year-old mother calls any teenage girl who dares to show her midriff in public. And so it's just, it just reminds me of Nana. So the Hussey case, I love cases like this because it proves that you got to follow the code through all its different cross references and all the potential implications. Okay. Very simple fact pattern for the most part. We got a guy who, through some LLCs, bought dozens of pieces of real estate over a period of years by assuming a couple $1 million in bank loans. Okay. So 2012 rolls around and he takes about half of those properties and he sells them in a short sale. So a short sale just means he sells them for far less than what he owes on the properties, but he gets the approval of the lender to do that. And usually what happens is the lender says, okay, you owe me $1 million, you're going to sell for 250,000. You still owe me 750. I'm going to forgive it. Okay. So in 2015, 2012, he sells about 15 of these properties in a short sale. He sells the remaining piece in 2016, all his remaining properties. But let's focus on 2015. He sells for such a small amount that he claims a big old loss on the sale of the property. And then he still owes the bank 750 grand and they forgive it and they give him cancellation of debt income. All right, a couple of different things to unpack here because I don't want to presume anyone understands this. Number one, what I love about cases like this is we can, if we're up to date on our case law, we can make a determination in this case, even though the case doesn't say it. And so I'm a dork about this stuff. I love to point it out. What we can learn about these bank loans is that they were recourse and not non-recourse. And why I say that is we talked about these cases last year. I always geek out on them. I wrote about them for tax notes this year. When I say recourse, not recourse, I'm not talking about like at the partner level under Section 752, which we'll talk about in the Cubs case. I'm talking about when the bank loaned this money to this guy. Well, he assumed the loans, but you get the idea. If a loan is non-recourse, it means if the guy doesn't pay, like in this short sale situation, there's nothing that the bank can do about it, right? They can only take the money he gets from the sale and they have to walk away from the rest of the loan, so they bear the risk of loss. If it's a recourse loan, it means not only can they force the taxpayer to sell the property, for example, at foreclosure, but if the amount doesn't cover the debt, they can go pounding on the door and say, you still owe me some more money. So how do we know this loan was recourse and not non-recourse? Because we learned last year, Damian Martin, that if it's a non-recourse loan, the Tufts case tells us that the entire amount of the loan is included in your sales price. And there can be no cancellation of debt income for two reasons. One, all the debt is actually in your amount realized. And two, how can there be cancellation of debt income when the lender was never in any position to collect that debt, right? Like they couldn't enforce it, so they can't forgive it. So when it's a non-recourse debt, the Tufts case would tell us you can't have this result, a loss on the sale of property and then COD income. But if it's a recourse debt, the Ozawa case tells us you have a bifurcated transaction. Treat the property as if it were sold for what it was sold for, recognize gain or loss, and then you still owe the bank 750 grand. If you pay it, no harm, no foul, no further consequences. But you ain't going to pay it because you don't have the money. So if the bank forgives it, then you have cancellation of debt income. And since here they had that split transaction, a loss on the sale of property and cancellation of debt income, we can infer that it was recourse debt, which has absolutely nothing to do with why we're talking about this case, but this is what we're here to do. Okay, so they pick up $750,000 cancellation of debt income. What does that mean to our listeners, right? If you're not familiar, well, under an old Supreme Court case called Kirby Lumber, we found out that if you borrow money from somebody, that's not a taxable event. But if the lender eventually says, don't pay me back, keep it, well, now you're richer than you were. And under Glenshaw Glass, which we talked about, you've got taxable income. Eventually, that was codified in Section 61A11. So now when debt is forgiven, we have cancellation of debt income. Okay, great. But anytime we have cancellation of debt income, we immediately have to turn to Section 108, because 108 provides a series of exclusions against cancellation of debt income, which I hate to call exclusions, because as we're going to learn here today, they really operate more as what? Deferrals, okay? And the idea here is if you're in such bad shape that you just had a bunch of debt forgiven, you're probably not in a position to pay a tax bill on the COD income. So like 108A1A tells us you have debt forgiven in a bankruptcy, well, you're not in a position to pay that tax. And so you don't have to pick up the income, you can exclude it. But how does it operate as a deferral? The price we pay for not picking up the income is we have to reduce attributes. So things like net operating losses or capital loss carry forwards or whatever it may be. And so in a future year, when you go to reach for that NOL and it ain't there anymore, it's a deferral because now you're going to pay more tax than you otherwise would have. Same thing happens under 108A1B if you're insolvent but not bankrupt. We've got exclusions under 108A1E for principal residence, 108E2 for expenses that liabilities that would have been deductible, E5 for purchase price reductions, all sorts of stuff. But what we're focusing on here is one of those areas that gets the least attention. All right, 108A1D. And what this was designed to do is to not immediately punish real estate investors who suffer big losses because property value goes down. So if you have a non-corporate entity, which is usually what you're going to have, right? So this doesn't apply for real estate in a C Corp, but how often are you going to see that? So if you have non-corporate entity owning real estate, and let's forget the sale concept right now, okay? So you own real estate and you go to your lender and say, I can't pay this mortgage. The property value's gone down. I'm not collecting enough rent. Forgive $1 million of debt. All right. 108A1D says we will forgive that $1 million of debt. But the way we're going to make it a deferral is at the beginning of the next year, first day of the next year, you're going to reduce your basis in all your depreciable property by $1 million. And so we find under 108 that your exclusion is limited to, you got to have enough basis, right? So if you have $1 million of COD, you better have at least $1 million of depreciable basis. But if you do, no problem. You don't pick up the income currently. You simply reduce your basis in the depreciable property on the first day of the next tax year, so that now you don't get depreciation deductions. Now you're going to have bigger gain when you sell. Okay? So that we can see how it works in the deferral context. But what's fascinating here is we did have a sale, right? We had a sale of 15 properties in 2012. And the taxpayer said Section 1017, which governs reduction of attributes, says reduce attributes on the first day of the next year. And so I can take a loss on these properties because I don't have to reduce the basis until the beginning of next year. Fair enough, okay? But is he right? So, depends. You got to read the law the right way. 108C2B says, as I mentioned to you before, you can only exclude COD under 108A1D to the extent you aggregate all the basis of your depreciable property and you have enough basis there to support that reduction in basis for the COD. So you have 750,000 of COD like this guy does, you better have at least 750,000 of basis. He had more than enough basis, okay? More than enough. Matter of fact, the basis in the property he didn't sell so the property he sold the next year was also more than 750,000, and that becomes relevant, okay? Because if you read the fine print and you kick over to 1017, 1017 says, yeah, generally you reduce your basis in property on the first day of the next tax year. But then 1017B3F, Damien, says, hold on. If you sold any property during the year and that property was part of the property you aggregated to determine you had enough basis to absorb a reduction in basis, then you have to reduce the basis in the property immediately before the sale. So think about what that means. That means he wanted to reduce 750,000 basis at the beginning of the next year. The IRS is saying, no, the property you sold in 2012 should have been reduced by 750 immediately before the sale. And what does that mean? That means 750,000 of more gain. And the taxpayer made one last ditch argument. He said, yeah, but I didn't need that basis to support the reduction. I had more than 750,000 of basis in the remaining property I didn't sell. And the court said, don't care. That's not how the language reads. The language says if any property that was part of your aggregation is sold during the year, whether you needed it or not, you reduce that basis prior to the sale. So that's a $750,000 swing in income, right? Because he wanted to do it next year, and now all of a sudden it's happening in the year before, and he's got to pay the tax well before he wanted to.
You talk about just mining the details there. I mean, just the complexity of 108 is, and just the intersection there. I mean, wow, right? You really got to plan that through and follow the code section.
Yes. I mean, every step, right? Because, and those code sections aren't even next to each other, right?
No, right. I guess that's kind of what I'm thinking there too. You're bouncing around a little bit,
Yeah, because you got 108 in the exclusion provisions that run from 101 to 140, but then you got 1017 in the basis adjustment provisions up in subchapter P, and and so they're not even next door, so you could see how you screw that up.
Well, yeah, and I think that was always the thing as like a student, and I consider myself still to be a student of the tax law, just always thinking, well, gosh, how am I going to remember and think about these code sections, like you said, when they're not even adjacent to each other? Like that just seems so difficult, so hard,
Yeah, but again, that's a good one for awareness too. I mean, 108A1D, I think, slips through the cracks far too much.